Welcome to the specialist trading presentation of the one indicator you should never use for trading, part 2. This is the specialist trading weekly stock, e-mini, and forex lesson. Hello everyone and welcome once again. My name is Primo. I am the president and founder of Specialist Trading, and this wraps up our two-part series of the one indicator that you should never use. And in this week's presentation, I'll go into detail showing you which indicator you actually should use for your trading. But before we begin, as always, I ask that you please take a moment to view our disclaimer. I'm going to show you some performance results using the indicator that should be in all of your trading scenarios. But please remember that we can in no way guarantee that any of the results I'm about to show you will be repeated in the future. So please take a moment to view our disclaimer, and then we shall begin this week's stock, e-mini, and forex lesson. All right, so let's review part 1. For those of you who may have missed our previous webinar in this two-part series, we talked about the one indicator that you should never use. And the reason why we talk about indicators that shouldn't be used is because they lead us down the wrong road. In other words, we rely on either methods or techniques or tips that have been taught to us through the years and think for some reason that because of conventional wisdom they will lead us down the road of success. But actually it's the exact opposite. What they do is stand in our way of success. And I feel that the reason why is because these outside sources that we've been taught to listen to, such as too many indicators, such as news, such as trading gurus, they actually make our trading much more complicated. When I suffered in my first years of trading, I couldn't get things going, and my mentors taught me that, Steve, the way you're going to get consistency in your trading will be if you keep your trading simple. So what we've learned through the years and what we teach all of our members is that simplicity will equal consistency. Consistency is success. In the long run, you want to be trading 10, 20, 30 years down the road. That's really what the true meaning of success is, and the only way to get there is by keeping your trading plan as simple as possible. And too many traders overcomplicate their trading by using what my mentors taught me as useless noise. In other words, tools or tips or techniques that really get in the way of our success. So once you strip away those things and keep your trading plan simple, you will ultimately get on that road to consistency. So last week we talked about the one indicator that you should never use for trading. Now we say here trading, and that is the news. And people will say, well, Steve, wait a minute. We need to know what's going on in the world or with a particular stock or an economic report or what's going on economically throughout the world to trade the forex markets. In actuality, yes, you do need to know those things if you are investing. But if you are trading, meaning you're holding anything from 5 minutes to possibly 5 days or a couple of weeks, those things will only get in your way. Let me show you what I mean here. We went over this last presentation. The LA Times reported in August of 2012 that Apple becomes the biggest company in U.S. history as its stock reaches $623 billion. Someone right off site would say, this is tremendous news. This is good. We should invest in Apple. But just a little less than 9 months later, on April 19th, 2013, what happens? CNBC reports Apple drops below 400 for the first time since 2011. The stock nearly lost half of its value in about 8 or 9 months. Okay, but I thought that was good news. And if we look at the chart going back, we see that on the 20th of August, circled in green, was where the news was reported that Apple is the largest company in history. Now, someone would just naturally say, of conventional wisdom, that is fantastic. That stock should be bought. But look what happened. Not nearly 2 months later, the stock topped out and went straight down, as you can see. Now, last month in April, on the 19th, guess what? Now the bad news comes out. It comes out that they're not living up to their expectations of selling their products. A lot of demand has not been met, and it turns out that the stock has gone from roughly 700 all the way below 400 for the first time in a couple of years. So this is really bad news. Now, how could we have sidestepped this, at least to stay out of trouble? Perhaps we would have used the news just to maybe enter or get in, but how could we have at least kept our losses to a minimum? Well, here is the one indicator that we feel as specialist trading that you should always, and I repeat, always use for your trading, and that is the buy-sell line. Okay, this is the single most important tool we have at specialist trading. Now, some of you who are new to these presentations may say, well, what is the buy-sell line? The buy-sell line is simply the 50-period simple moving average. That's all it is. Now, someone could say, well, what does that have to do with it? That's too simple, and in fact, it is a simple moving average. It's too simple. How can this possibly help me with my trading? Well, here's the way you use it. In order to use the buy-sell line properly, all you have to do is ask yourself this question before each trade, and that is, where is price in relation to the buy-sell line? Okay? I'm going to repeat that again because this is how important it is. Before you pull the trigger, regardless if it's based off of some news event or some other indicator, some technical analysis or whatever, support and resistance or Fibonacci, whatever you decide to use to enter your trades, before you enter, ask yourselves, where is price in relation to the buy-sell line? And you'll only come up with two possible answers, because if price is above, then you should only be looking to buy. Then in other words, you should only be getting buy signals. You shouldn't consider going short. And if price is below, then you should only be looking to sell or looking to go short. This is how simple it is, but let me show you how powerful and how it could have helped you in that Apple example. Let's go back to the chart. As we see here on the 20th of August in 2012, circled in green there, that's where the good news came out, okay? And we see here on the far right, that's April 19th, excuse me, April 19th, the bad news came out. Now, how could we have at least sidestepped all this terrible sell-off in Apple, where we would have entered on the good news, but at least would not have lost as much as you see here? Well, let's add the buy-sell line, which is simply the 50-period simple moving average. And remember, we tell ourselves, where is price in relation to that buy-sell line? Now, if we look at that area in the far left-hand corner circled in green, well, price was above the buy-sell line, so okay, you could have taken that as good news, and had you gotten some type of signal based off some type of strategy or structure, you could have purchased Apple in good faith, knowing that it was above the 50-period simple moving average. But look what happened a couple of months later. We had consecutive closes below the buy-sell line. So basically, that was your signal to get out of the trade, to exit, or to move your stop up to protect yourselves, because things weren't working out. Most likely we were going to be heading lower. So do you see how this simple tool could have saved you roughly 400 points to the downside? Okay. Now, as we look to the far right-hand corner, we see circled in red, that's when the bad news came out. So someone, I don't know why they would want to, but someone would want to short off that or sell off that. Well, okay, you could have, but look what happened. Just weeks after that news came out, where was price in relation to the buy-sell line? Well, price moved back up above. So someone could say, well, maybe we should consider going long Apple. So this basically is, for all intents and purposes, where Apple is roughly right now. So Apple is at the same prices above the buy-sell line. So if you have some structure, if you have a strategy in place that gives you a buy signal, well, then you would be in sync with the buy-sell line. It would be okay to purchase Apple. Now, we're not going out here and recommending that you buy Apple, because we don't have a buy signal per se per one of our strategies. But it would be in accordance if you did get a signal according to one of your methods to buy Apple right now, because it is above the buy-sell line according to our rules. Okay? So do you see how this simple tool could have gotten you out of Apple roughly around 650? And then if you were thinking about getting back in, if you really loved Apple that much, well, you could get back in roughly about 200 points later. This is a tremendous, tremendous tool. It's great for trading and great for using along with any strategy that you may be currently using. All right, so let's recap. Now, we stated in the very beginning why you should never use this indicator for trading, but who should use the news? If you're going to use the news as an indicator or as some type of help in deciding when to enter or exit a trade, who should be using this? Well, we have two types of people. There are investors and there are traders. Investors are people that hold on to positions anywhere from a year to 10 to 20 years down the road, where traders are people that hold on to positions either long or short, from 5 minutes to maybe a couple of months. So between the two, who should use the news, or who should apply the news diligently to their trading? Well, the answer is investors. If you are an investor, if you're not a trader, if you're holding things for the long term for your retirement account, yes, you should take the news into account. You should see what a company is doing or what's going on economically within the world. But if you are a trader, should you be using the news? Definitely no, because there's no way it's really going to help you. It may work every once in a while, but most of the time it won't. It'll just be too complicated trying to discern if the news is good or bad. Remember, that was very good news in Apple, and guess what happened? It went straight down a month after that. Okay? And there was very bad news in Apple a couple of weeks ago, and guess what happened? It's gone straight up ever since that news came out. So News will only make things more difficult. And what did we state at the very beginning of the presentation is that the road to success is paved in simplicity. All right, is news simple? No, it's very hard to discern. It's too complicated. It's too subjective. Therefore, it's not simple. We want things that are more cut and dry, like the buy-sell line. If price is above, we're looking to buy. If price is below, we're looking to sell. It doesn't get much simpler than that. Okay, as we conclude this week's stock, E-mini, and Forex lesson, remember we talked about the one indicator you should never use for trading. If you're an investor, it's perfectly admissible to use that. In order to get this consistency in your trading, keep things as simple as possible. That means learn all of our strategies and then paper trade them so that you can understand how this process unfolds in real time. That's our edge here. From time to time, our strategies and our methods will hit home runs, but that's not our goal. Our goal is to have this nice consistency in our trading so that your P&L chart looks very nice and has a very steady upward slope in it as opposed to kind of a roller coaster as so many traders have. In conclusion, I ask that you take one last look at our disclaimer. I showed you some performance results using the buy-sell line. Please remember we can in no way guarantee that any of these results will be repeated in the future. So thank you so much for attending. We look forward to attending these weekly webinars, and we wish you the best of luck trading. Bye-bye.